Okay, so yes, this question came in from James via email, and he says, "Is Converge technology a buy now that it is growing revenue and earnings?" So Converge Technology Solutions, CTS on the TSX, currently trading at a price of around $4.12, market cap of 813 million, and a dividend yield, which is forward, of just under 1%. So Converge Technology is a software-enabled IT and cloud solutions value-added reseller, which is focused on delivering advanced analytics, application modernization, cloud, cybersecurity, digital infrastructure, and digital workplace offerings to clients in various industries. Now, we have covered Converge Technology several times on the podcast now, and I've kind of shown up on the screen here the fundamentals each time that I looked at it. So the first time was in October of 2020, the second time was in March of 2022, and the last time was May of 2023. And every time my conclusion was essentially along the lines of the business having great growth driven by acquisitions, which was funded by both debt and equity dilution, but the stock had very thin margins, which made it difficult to justify gaining a substantial EBITDA or price to cash flow multiple. So I'll just quickly pop this up on the screen. This is where they are located, or their locations are. A few years ago, they moved into Europe as well. Looking at some company updates, the last time I discussed the stock, management had concluded a strategic review process to evaluate a full range of alternatives where they were looking at potentially a sale, a merger, divestiture, recapitalization, or other strategic transaction, as well as just potentially continuing to go as an ongoing entity, which is what they ended up concluding to do. So they were just going to do that going forward, of course. Now, recently, the board of directors also authorized the initiation of a quarterly dividend of 1 cent per share. And the company also has been buying back shares under their NCIB, where I've actually included, if you look at the chart on the screen, they haven't issued any new shares since 2021 and have been slowly reducing the count there. Now, it may also be worth to mention that the company is also integrating a new ERP system by the end of 2024 in North America and then in 2025 in Europe, which they believe will help increase margins. I don't know. We'll see if that actually transpires. And as well, in the company's Q1 conference call, management indicated that they were pausing on acquisitions to focus on integration, cross-selling, and cash generation. So seeing that the last quarter reported was actually Q3 and their last acquisition was closed late of last year, 2022, the Q4 results upcoming will primarily be just organic growth. So we'll be able to see there. Now, actually moving over to the financials. So like I said, recent financial results for Q3 of 2023, net revenues were up 38% to 710 million compared to the same period last year. Now, gross sales organic growth was 24% year over year, but keep in mind, this is organic growth of gross billing sales as compared to the actual net sales that Converge brings in. So I included there just a table that shows their organic growth on the quarterly as well as the year-to-date numbers as well. Now, adjusted EBITDA increased 33% to 41.3 million, and that's an adjusted EBITDA margin of about 5.8%. GAAP EPS was a loss of 1 cent in the quarter, and adjusted EPS was flat at 10 cents per share compared to the same period last year. Now, the reason for the decline in profitability margins was due to a product mix from higher hardware sales during the quarter, as well as several of the acquisitions completed last year are high volume, low margin businesses, is what the management said in their conference call. Now, the company now has net debt of 307.5 million and a trailing net debt to EBITDA multiple of about 1.8 times. And over the last 9 months, they're paying about 7.4% interest on that debt. And this compares to about 5% same time last year. And looking at the valuations, they're trading with a trailing EV to EBITDA of just under 7 times and a price to cash flow multiple of 5.6 times. Now, the company also provided adjusted EBITDA guidance for Q4 of 2023 of 46 million at the midpoint, which will equate to about 7% growth year over year. But without any net revenue guidance, we are in the dark essentially on what the adjusted EBITDA margin is anticipated to be. However, something that I find interesting is that management references that it targets a 30% adjusted EBITDA to gross profit margin. So over the next few years, rather than a typical adjusted EBITDA margin, they're looking to get to this adjusted EBITDA to gross profit margin of 30%. And if we look at this most recent guidance, that place for Q4, that places them at this margin of 25%. So, I find it weird that they're quoting that rather than just a normal adjusted EBITDA margin. So moving on, just quickly looking at GAAP net income to adjusted net income. I did this last time in May, but let's do it again just to see how the company is adjusting its net income. You can see that every quarter the company is adding back significant acquisition, restructuring, and other related expenses due or related to their acquisitions. Now, personally, I think that adding back these special charges may be a little suspect as the company is consistently making acquisitions and incurring these costs. So, it's expected to go forward, essentially. So to conclude, now revenue growth has been tremendous, driven by an aggressive cadence of acquisitions, but in the near term, management plans to slow down on acquisitions and focus on integration. Essentially, we have seen the company go from significant net debt to then issuing shares to improve the balance sheet and then get back into a net cash position. But now the company is back into a significant net debt position with net debt of about $307 million and a net debt to EBITDA multiple of about 1.8 times, which the last time I covered it in May, it was 2.1 times. So it is improving, which is nice to see the company paying down its debt and growing its EBITDA and continuing to not issue shares essentially and buy shares back. But I still think that they've got work to do on that balance sheet. Now, the company also pays a dividend yield of under 1%, which equates to an outflow for the company of about $8 million a year. Personally, for the ever so slight yield, I think I would rather the company just continue to pay down its debt or utilize it for acquisitions. So, that it doesn't have to dilute in the future. So, some people might like the dividend. I don't know if I like it that much. As well, looking at the valuation, the company trades with an EV to EBITDA multiple of under 7 times, but adjusted EBITDA margins and net profit margins continue to be very thin, and management has voiced that they anticipate to increase them for several years now, and we did see them increase over 2021, but that growth in margins has kind of stopped around that 6% mark. So to answer your question, James, on whether it is a buy right now, it continues to be a company which we simply monitor and not a name which we would recommend to our clients.
So for some people wondering in terms of, the nature of their business, as Brennan said, they're a reseller, right? So essentially like a distributor. So they don't have their own technology. They're not selling their own projects or products and services or developing their own technology. They sell other people's technology essentially. And that's why the margin is so low.
Yeah,
and it is that industry is characterized by lower margins. And I also noted that their margins were actually down compared to the previous year. So they're already low.
That's what I was going to say, honestly.
Yeah, they've come down.
Yeah.
Sorry for stealing your thunder there.
No. Like, I don't know if you had more, but it's always been a story about increasing margins over time. And we just look at the last quarter, and on an adjusted EBITDA basis, on an adjusted net income basis, margins were down again. So again, show me you can actually increase, because like they're low. If you can increase sales, but your margins are going down, there's not much a point to the business, to be honest. I mean, I get you can generate cash flow, but we talked about low margin businesses in the office over the course of the week. One thing we like is low to, or just good cash positions in those businesses. But, this company doesn't have that either. And, it's just, I would like a higher margin, or at least to be inching those margins up, because that is what this company has said they stated goal as they went public, and to consolidate this industry is to achieve higher margins over time. We see lower margins at present, quarter over quarter.
Yeah, like you just looked at a trucking
or year over
company
year, sorry,
with adjusted EBITDA margins of, what was it, 12% on titanium transportation, something like that.
Mm-hmm.
This is a technology company with EBITDA
well,
margins.
And even
I mean,
12%
I get it.
EBITDA
They're
margin's
not.
not,
yeah,
I get
12
it.
is
it's not
But
that great. But
no, but
when you're
just
talking like
comparing.
the 5-6% EBITDA margin and you have debt,
Mhm.
so your interest payments come out of that before you get to your net profit, right? So they're reporting negative net profit, but then positive on an adjusted basis, right? It's we just had an interview with a CEO of a company it's also a low margin business, but it was a net cash business, and he was talking about how, given that it's a low margin business, he didn't think that there is any room for debt in the capital structure, and we agreed because
we agree more with that philosophy,
Mhm.
right?
Yeah,
And
I mean,
in
if
this
you're
case,
already producing tiny margins and then the rates go up like they have in the last year, I mean, you can go from being profitable to losing money quite quickly. So